Hey folks, I'm Chris Shank and I'm your mortgage advocate. In this video, I'm going to give you a few tricks to identify scammers and other less than honorable lending practices to ensure that when you go for your next home loan, you're less likely to fall for a trick that could cost you a lot of money. As always, we're going to do this by following the dollar. Congratulations, future homeowner. You've made the decision to buy yourself a house. Because you're a well-educated individual, you took your mortgage advocate's advice and got yourself pre-approved for a loan before wasting your realtor's time looking at houses well outside your price range. Regardless of whether your loan officer ran a hard or soft check during this pre-approval process, your lender will likely require at least one hard credit pull on file in order to lend you money. This means that whether you like it or not, the fact that you're looking to finance yourself a home is now public information that will almost immediately be scrubbed and sold to people who think you are an easy mark. Doesn't that just make you feel all warm and fuzzy? Thankfully, front-end spammers are usually easy to identify. Here's a hint. If you didn't initiate contact with a lender or mortgage company, and a representative from that company reaches out to you, that company likely bought your data and just outed themselves as such. Now, I say spammers instead of scammers because most of the time, these companies legitimately offer loans even if they approached you in a less than ethical fashion. The problem with these companies is that because they have no rapport with you, they're going to try to lure you with the only leverage they have, which is to quote you ridiculously low prices. More on that in a bit. Let's say that you've successfully hung up on a dozen spam calls, but your friend knows this guy whose brother is a loan officer who claims to beat any rate out there. You open a dialogue with this smooth talker who slides you a quote that looks pretty darn good, especially in comparison with the one from your original company. How do you compare the two? Before you start, it's essential that you get what's called an estimated fee sheet from your lender because this will clearly detail the cost of your loan as well as help you compare between two radically different quotes. Okay, that's settled. Buckle up, folks, because we're about to go pretty crazy with some numbers. The first thing that you are likely going to look for is the interest rate. As we identified in a previous video, mortgage rates are caught in a tug-of-war battle between lenders trying to keep them low enough to attract new clients while still high enough to be sold as competitive mortgage-backed securities. When a lender quotes you an interest rate, it is tied to something called the par rate, which is essentially the rate at which your loan will be written at if you don't pay any extra at closing to buy down your interest rate. As a rough rule of thumb, for every 1% of the value of the loan you pay at closing to discount your rate, you can drop your interest by 1/4 to 0.5%. Look at this example. See at the top that this quote is offering 6%. If the talking heads on the news have told you that mortgage rates are around 7%, but you're looking at a quote that says that a company can get you a loan at 6%, more than likely they're able to do that by having you come to the table with a couple discount points. Look at your estimated fee sheet under origination expenses. If your sheet looks like this one and the origination section is blank or it lists a $0 fee after points, ask that loan officer to confirm whether he has you coming to the table with any points to get that rate. Best case, he simply forgot to include those fees. Worst case, he left out several $1,000s worth of costs to make his numbers look better. Not gonna lie, the first loan I lost was due to this. I had my client quoted at a 6.25% interest rate, and that was going skinny for the market at the time. Another lender stepped in, quoting 5.25%, and my client decided to go with what he thought was the better offer. 2 weeks later, his realtor reached back out to me to share that the other lender conveniently forgot to share with my client that he'd need to come to the table with an extra $8,000 to get that 5.25%, money that my former client definitely didn't have. At this point, the lender re-ran his numbers, which ended up with my client securing a rate of 6.75% and coming to the table with $2,000 more than I had quoted him in the first place. Unfortunately for my client, because he switched lenders mid-contract, he didn't have enough time to start over with another lender and was forced to choose between taking a higher rate or losing the house and his earnest money. Besides your interest rate and discount points, something that you should look for are underwriting and processing fees. Getting a mortgage from start to finish takes dozens of hours of work and involves several professionals, each of whom kind of wants to be duly compensated by their work. A lot of the lenders out there will have you simply pay these costs at closing, to which end you'll see their respective costs in that fee estimate. If you don't see these costs, like in this example, it doesn't mean that they don't exist. Best case, you've secured yourself the rare lender that covers these in-house. Worst case, your loan officer forgot to include these fees as well. If it's the former, verify with your loan officer that even though the company is covering these services in-house, you're not paying for it on the back end with a higher APR or having those costs built into your loan. Okay, enough on origination costs. Look down your documents and find the section that lists title expenses. In a home purchase, the buyers and sellers negotiate which title company they'll use to oversee the transaction. This title company will set their fees, not the lender. Occasionally, I'll see shady loan officers leave out title fees, or at the least underrepresent them in a bid to trim money off the final estimated bill, only to add them back later and blame the title company. Now, on to taxes. Here in Tennessee, it's pretty much expected that the buyer of the home will pay transfer taxes on that property. Again, I've seen crafty LOs leave out tax items to make their loan seem thinner than it will be in reality, like in this example. Yes, this fee sheet has deed and mortgage fees, but on a $260,000 purchase in Tennessee, there's over $900 worth of transfer taxes missing. My advice is this: if you're comparing two estimates and one has the taxes section fully populated and the other does not, the former likely has done their homework on your area, while the latter is either lazy, shady, or simply is not familiar with how loans in your area are expected to run. At the end of the day, you will pay the same on taxes, regardless as to which lender you go with. Lastly, we come to my favorite sections: prepaids and escrow. When you buy a home, you're expected to secure 1 year's worth of homeowner's insurance and to pay your fair portion of that property's taxes for the year. Now, you, as the client, have control over your homeowner's insurance, but because that has to be paid for at closing, who you go with will directly affect how much money you may need to come to the table with. In my experience, the most common way that I've seen loan officers trim the fat off quotes is by underestimating insurance costs. Check out this example. Now, if you know me, you know that I'm a recovering insurance agent, so this is kind of my jam. In Tennessee, the average homeowner's insurance policy costs just over $2,100 per year, which translates to $175 per month. When I quote my clients, unless they have a homeowner's insurance quote in hand, I will put a placeholder value of $175 per month in their estimated fee sheet, which will necessitate them coming to the table with at least $2,100 in closing costs to cover their homeowner's insurance policy. 3 weeks ago, a client of mine showed me the quote from a competitor who estimated their monthly homeowner's insurance policy to be $50 per month on a $500,000 house. You, dear viewer, can hopefully understand that this other officer's estimation was a bit off the mark. However, according to that section of his fee sheet, his numbers were $1,500 lower than mine, which is not an insubstantial sum of money. You may call me a pessimist, but here's the unfortunate reality. Lenders make a lot of money writing mortgages, and I'd be lying if I said that loan officers don't make their fair share of that pot. Realistically, once a client has set their heart on a lender, they are unlikely to move to a different lender and restart the whole process, even if their cost to close or interest rate is notably higher than they were initially quoted. Knowing that, there are a fair number of loan officers out there who use clever advertising, or let's call it what it is, manipulation, to snag that initial business, knowing that their initial quoted numbers may not be as accurate as they portray them to be. It sucks, but shady folks exist in every industry. What you can do is be wary about how they operate. Build rapport with the professionals you entrust with your future and ask them hard questions. Give them the opportunity to prove their value and advocate for you. After all, for every scam artist trying to make a quick buck off of your future, there's someone out there raring to prove to you how a true professional treats their people. This is Chris Shank with Mortgage Advocacy. Thank you for joining me today as we talked about one of the darker sides of lending. As I'm fond of saying, it's all right to hope for the best so long as you're aware of the worst, especially when your family's well-being is concerned. Stay safe out there.